Do you know how to reduce your required minimum distributions to help lower taxes on your Social Security benefits? Well, if not, we're going to be discussing how you can do this in our financial freedom video, so definitely stay locked in. Hi, my name is Carson Graves, Certified Financial Planner and President and CEO of the Retirement Education Center.
And my name is Andrea Graves, Director of Operations at the Retirement Education Center. For additional concepts on how to maximize your retirement, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos. So Carson, today you want to cover an important topic for many retirees, and that is how to reduce required minimum distributions to help to lower the taxes on Social Security benefits. First of all, what are required minimum distributions, especially for those of us who do not know?
Of course, many retirees know this terminology, but for those of us who may have not hit that particular age yet, Andrea, required minimum distributions are simply minimum distributions that the IRS is going to make you take out of your IRAs or your 401ks, 403bs, or 457bs when you hit a certain age. That can be the age of 73 or the age of 75, depending on when you were born. Now, when you start taking these particular withdrawals, Andrea, they are subject to income taxes and they can impact the taxation on your Social Security benefits. So today, what we're going to do is cover two things that you should really consider doing if you're wanting to make sure that those required minimum distributions do not affect the taxation of your Social Security benefits. But before we get into those two things, there are always two rules to retirement income that we like to give you. And Andrea, what are those two rules?
Well, rule number one is to never run out of money, and rule number two is to never forget rule number one.
Okay, so let's go ahead and jump into our lesson today to talk about ways that you can impact your required minimum distributions so that they do not have an effect on the taxation of your Social Security benefits.
Carson, the first thing that people should understand is the impact of how required minimum distributions affect the taxes on Social Security.
Yeah, this is really important because required minimum distributions, Andrea, could significantly impact your income, increasing it to a point to where it significantly impacts the taxation on your Social Security benefits. That is why it is really important that you sit down with a qualified financial advisor to maybe help you plan early for this particular tax bomb to help minimize the impact that this could have on your benefits. For example, imagine if you were a married couple and you were comfortable living off of $80,000 a year from your Social Security benefits. Well, only half of those funds would be considered taxable income. So they only use half of those benefits of that $80,000. Therefore, $40,000 would be considered taxable income in this particular situation. Well, if you are a married couple and you do have income that is considered between $32,000 to $44,000, only up to 50% of those Social Security benefits would be subjected to taxes. But once you hit your required minimum distribution age and you are mandated to take taxable distributions from your retirement accounts, as little as a $4,000 distributions from any accounts could actually expose your Social Security benefits to being taxable to up to 85%. So you can really see why it would be so important that you're able to get out ahead of this particular tax bomb and start trying to plan early on how to minimize those RMDs so you're not pushing to the 85% taxation on your Social Security benefits.
Okay, Carson, now that people understand the taxable implications of their required minimum distributions, what actionable steps can they take at this point?
Well, Andrea, there are really three actionable steps that people should be doing in order to reduce the impact of their required minimum distributions. One effective strategy that many people may not be aware of is making qualified charitable distributions when they reach the age of 70 and a half. Now, when you make a qualified charitable distribution, you are directly transferring money from your IRAs directly to a charity of your choice. Now, these particular distributions are not only able to satisfy your required minimum distributions for the year, they are not even included in your taxable income. This would not only help you reduce taxes on your required minimum distributions, it would obviously help reduce taxes on your Social Security benefits as well. Another highly utilized strategy are Roth conversions. Here, all you would do is simply convert a portion of your traditional IRA assets into a Roth IRA during a time, I would tell you, in which it would be more advantageous for you, like before you have actually started your Social Security benefits or when you're in a lower tax bracket, due to the fact that a Roth conversion will trigger immediate taxes. But of course, this strategy can help reduce future RMDs, as Roth IRAs are not subject to the RMD rules and they are not considered taxable income if you decide to take money out of a Roth IRA. Now, the last actionable thing that you can do is sit down with a certified financial advisor that can help you plan for a proper withdrawal strategy. By carefully planning when and which accounts that you will be pulling from based off of their tax implications, you can optimize your income streams while minimizing the taxes on your required minimum distributions and your Social Security benefits.
All right, Carson. So what's the moral of this video?
Well, the moral of this video is that reducing your required minimum distributions can help you lower taxes on your Social Security benefits, allowing you to maximize your retirement income. But as always, it will be important for you to sit down with a certified financial planner or a tax preparer in your area to help you implement some of these strategies. Please note that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today.
After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
We have answers.